Chapter 26 Taxes and Assessments Introduction. Objectives. In this chapter, we will discuss the assessment process, tax rates and how taxes are levied. At the end of this chapter, you will be able to 1. Discuss the purpose of taxation and how real estate taxes are assessed and calculated. 2. Describe the reassessment procedure in New York and equalization between taxing jurisdictions. 3. Discuss special assessments and tax exemptions. 4. Explain how property owners can contest and appeal tax assessments, and the possible outcomes. Key terms. There are several important terms in this chapter. Remember to pay particular attention to these terms when you see them. Ad valorem taxes. Appropriation. Assessed value. Assessing unit. Approved assessing unit. Assessment. Assessment Review Board. Homestead non-homestead. In rem. Levy. Lien. Special assessment. Special assessment districts. The New York Bureau of Educational Standards requires that you spend 150 minutes studying the material in this chapter. Your course timer can be found in the upper right-hand corner of your screen. Purpose of taxation. The purpose of taxation is to raise funds to pay for municipal services. The collection of taxes provides important revenue for the local government and for area schools. Property taxes are based on the assessed value of the property. These values are also used to calculate the amount of state aid for education. Assessing units such as counties, cities and municipalities, townships and special assessment districts levy taxes on real property to raise funds, as we said, for providing local services. It is common for the county to collect all real property taxes and distribute it among the other taxing bodies. County and local governments establish tax districts to collect funds for providing specific services. The boundaries of such districts typically do not coincide with municipal boundaries. The major tax district in most areas is the school district. Other important tax districts are those for fire protection, community colleges, and parks. A property tax bill might include tax levies from such districts as the following: bridge and highway, nursing home, stormwater management, township, fire district, school district, retirement fund, health services, historical museum, sanatorium, forest preserve land management, public library district, park district, community college district. Taxation. General property taxes are levied on an ad valorem basis, meaning that they are based on the assessed value of the property. Assessed value is determined according to state law, usually by a county or township assessor or appraiser. In New York, the real property tax is based on a property's fair market value. Exempt properties. All real property in New York is subject to assessment. Both residential properties and commercial properties, including vacant land, are assessed. All real property in New York is also subject to taxation, unless specific legal provisions granted exempt status. Real property tax exemptions are granted on the basis of many different criteria, including the following: the use to which the property is put, the owner's ability to pay taxes, the desire of the state and local governments to encourage certain economic or social activities. Certain exemptions provide full relief from taxation, that is, the property is wholly exempt. Other exemptions reduce the taxes which would otherwise be payable by varying degrees, making the property partially exempt. Some exemptions apply to taxes levied for county, city, town, and school purposes, whereas others pertain only to some of these purposes. While some exemptions are mandated by state law, in other cases the municipalities are given the right to determine what exemptions to grant, who will be eligible and in what amounts. Properties owned by governments and religious organizations are wholly exempt. Other exemptions exist for agricultural and forest property. Exemptions may also be granted to not-for-profit educational and charitable groups. Why tax land? There are valid reasons why it is beneficial to tax land and land improvements as opposed to relying on only sales and income taxes for revenue. Property tax revenue is predictable. The fair market value of property is generally very stable. The taxes are hard to conceal. Because the taxes are tied directly to the property, people tend to pay the taxes rather than suffer the potential consequences of non-payment. More than 95% of the levied taxes on real property are paid, especially since most lenders require that the property taxes be paid into an escrow account monthly. There is an historic relationship to wealth and land productivity. For hundreds of years, land ownership has been viewed as an indicator of wealth. In most cases, land has some measure of productivity and the government shares in that. Property taxes are levied on all kinds of property, residential, agricultural, commercial, and industrial, etc. Taxes received from these properties amount to about 1/3 of the revenues that local governments receive. Calculating real estate taxes. Tax bills are calculated based on two items of information: the assessment of the property, the tax rates of the tax district in which the property is located. The property's assessment is a percentage of its fair market value, which is the amount the property would sell for in the current market. The tax districts we talked about on an earlier screen generate the annual revenues they require by levying taxes on their tax base. The tax rate, or millage rate, determines how much of a tax levy the tax base will receive. The tax rate for each tax district is calculated by dividing the amount of revenue required by the tax base. This rate is then applied to the taxable value of each individual real property to determine its tax levy. The figures below show the sources from which a town's annual budget revenue could be generated. Property tax 54.84%. Non-property tax 0.92%. Federal aid 5.15%. State aid 34.66%. All other 4.44%. Source: New York State Office of the State Comptroller calculating real estate taxes. Here is the formula for calculating property taxes. Assessed value x tax rate equals annual taxes. So, let's do an example. The assessed value of a property is $70,000. The tax rate is $1.25 per $100 of value. So, the annual taxes would be $875. $70,000 x 1.25 100 equals annual taxes. $70,000 x 0.0125 equals $875. Let's do another example. A property has an assessed value of $155,500. The property is taxed at 80% of its assessed value at a rate of $2.10 per $100 of value. The annual property taxes would be $2,612.40. $155,500 x 80% equals $124,400. $124,400 x 2.10 100 equals annual taxes. $124,400 x 0.021 equals $2,612.40. Homestead versus non-homestead properties. As we said earlier, an assessing unit is a city, town, county or village that has the power to assess real property. An approved assessing unit is a tax district that has been certified by the NYS Office of Real Property Services as having completed a property revaluation program, which implements a system of real property tax administration that would be eligible for state assistance. Approved assessing units may establish different tax rates for homestead and non-homestead real property, thereby allowing some tax relief for owners of homestead properties. The NYS Office of Real Property Services defines the homestead class as 1, 2, or 3 family residential dwellings, owner-occupied and separately assessed mobile homes, residential condominiums, parts of parcels primarily used for farming purposes, which accommodate farm dwellings, and improvements exclusively used for residential purposes. All vacant land parcels, not exceeding 10 acres, which are located in an assessing unit which has a zoning law or ordinance in effect. These parcels must be located in a zone that allows only a residential use for 1, 2 or 3 family residential real property. Land used in agricultural production and all farm buildings and structures located on such land. The NYS Office of Real Property Services defines the non-homestead class as all real property that is not included in the homestead class. This would include commercial, industrial and utility properties as well as some vacant land. Assessed value. As we said earlier, general property taxes are based on the assessed value of the property. A property's assessment is based on its market value. Market value is how much a property would sell for under normal conditions. Assessments are determined by the assessor, an elected or appointed local official who independently estimates the value of real property in an assessing unit. Assessing units follow municipal boundaries, county, city, town, or village. The assessor can estimate the market value of property based on the sale prices of similar properties. A property can also be valued based on the depreciated cost of materials and labor required to replace it. Commercial property may be valued on its potential to produce rental income for its owners. In other words, the assessor can use whatever approach provides the best estimate of a property's market value. They must be assessed at their current use value. Relationship to full or market value. Once the assessor estimates the value of a property, its total assessment is calculated by multiplying the market value by the uniform percentage for the municipality. The percentage of full or market value at which properties are assessed is called the level of assessment or LOA. For example, an LOA of 25% means that assessments in that unit are 1/4 of the market value. So, a home with a market value of $100,000 would be assessed at $25,000. New York state law provides that all property in a municipality be assessed at the same uniform percentage of value. That percentage can be 5%, 10%, 50%, or any other percentage not exceeding 100%. It does not matter what percentage is used. What is important is that every property is assessed at the same uniform percentage within one assessing unit. New York encourages their municipalities to keep the assessments up to date annually. They promote this compliance by providing state aid of $5 per eligible property to all taxing districts that keep their assessments at 100% of market value each year. After a property's total assessment is determined, its taxable assessed value is computed. The taxable assessed value is the total assessment minus any applicable property tax exemptions. Exemptions are typically either whole or partial. We'll talk more about specific exemptions later in this chapter. Assessment ratios. New York State real property tax law mandates the calculation of residential assessment ratios annually. The assessors use RARs as a general measure of assessment equity. Taxpayers use RARs in Board of Assessment review grievances and/or small claims hearings. On May 21, 2008, the governor signed legislation that amended Real Property Tax Law Article 7, Title 1-A, Section 738, changing the definition of the residential assessment ratio. Previously, the median ratio of residential sales compared to assessed values was calculated to determine the RARE. The amended law now specifies that the RARE shall be equal to the level of assessment of residential property used to calculate the state equalization rate for that assessment roll. This amendment became effective for all assessment rolls with a taxable status date on or after September 1, 2008. 60 days prior to the date for the filing of the tentative assessment roll of an assessing unit, the state board will determine the RARE for that assessing unit. The RARE will be equal to the level of assessment of residential property in the assessing unit as determined in the market value survey used or to be used to calculate the state equalization rate for that assessment roll. The RARE will be made available at the Office of the County Director of Real Property Tax Services, the Office of the County Clerk and the Office of the Assessor. In a city with a population of 1 million or more, such as New York City, The RARE will be made available to the Office of the Tax Commissioner of that city. The RARE will also be provided to the Office of Court Administration for distribution to small claims hearing officers. Equity issues. As we said on an earlier screen, the real property tax is an ad valorem tax, or a tax based on the value of property. Two owners of real property of equal value should pay the same amount in property taxes. By the same token, the owner of more valuable property should pay more in taxes than the owner of less valuable property. Why assessments differ? Assessments naturally differ when the value of the properties are different. But they can also differ if they are not regularly updated. If a property in a certain neighborhood increases in value but is not reassessed, over time it will become underassessed. For example, Mr. Temple and Mr. Green both purchased homes in Smallville 5 years ago. The purchase price for both homes was $150,000, so the tax bill for both properties was the same. Smallville has not updated its assessments in the past 5 years. Because of its location, Mr. Temple's home has increased in value to $200,000. Mr. Green's home has also appreciated, but not to the same degree. Mr. Green's home is worth $160,000 now. Even though their property values have increased, both homeowners have been paying the same amount in taxes since they purchased their homes. If the property in Smallville is reassessed, both Mr. Temple and Mr. Green will see an increase in their tax bill appropriate to the increased value of their homes. This will increase the town's revenue. Other homeowners in Smallville may see no change in their property values, while others may see a decrease in the value and a decrease in their tax bill. Reassessment. Properties are reassessed for tax purposes on a regular schedule that is established by statute. But reassessments also occur under other circumstances. Reassessments can be done off schedule when a property owner makes improvements to the property. Assessors are not allowed to do what are called spot reassessments on an individual parcel of property unless it is obvious or it has been reported that a material change was made to the property. Renovations to property often increase the value of that property. The assessor needs to do an evaluation to see if that is the case and, if so, increase the assessment of the property. Old versus new construction. Some types of construction projects are more likely than others to prompt a reassessment. These types of projects might include finishing a basement into a family room or other living quarters, adding a garage, installing an in-the-ground swimming pool. If the assessor sees that these renovations are not in the current tax record, he or she will reassess the property to include those changes. Undeclared improvements. Most property improvements require a building permit of some kind. Building permits are periodically reviewed and the property records are updated to reflect any changes. However, sometimes improvements are undertaken that are not reported. If the assessor makes a habit of cross-checking applications for building permits, he or she may discover and be able to inspect improvements to a building or property that have been completed. The International Association of Assessing Officers guidelines state that assessors should conduct a physical review of properties at least every 4 to 6 years, including an on-site verification of property characteristics. In order for a municipality to qualify for state aid in New York, the municipality must implement a program to physically inspect and reappraise each property at least once every 6 years. Check your understanding. Print this screen. Answer the questions and then advance to the next screen to see the answers. 1. What is the purpose of taxation? 2. What does ad valorem mean? 3. What is an approved assessing unit? 4. What kinds of construction projects might trigger a property's reassessment off schedule? Check your understanding. Answers 1. What is the purpose of taxation? To raise funds to pay for municipal services, such as local government and area schools. 2. What does ad valorem mean? The taxes are based on the assessed value of the property. 3. What is an approved assessing unit? An approved assessing unit is tax district that has been certified by the NYS Office of Real Property Services as having completed a property revaluation program, which implements a system of real property tax administration that would be eligible for state assistance. 4. What kinds of construction projects might trigger a property's reassessment off schedule? Renovations that might increase the value of that property, such as finishing a basement into a family room or other living quarters, adding a garage or installing an in-the-ground swimming pool. Community-wide reassessment. Each year, state law requires assessors to sign an oath that the community assessments represent a uniform percentage of market value. The best way to ensure that assessments are consistently fair and uniform is to keep assessments up to date annually. As we said earlier, to encourage compliance with state law, New York State provides state aid of $5 per eligible parcel to municipalities that keep assessments at 100% of market value each year. It's much easier for taxpayers to understand assessments and determine whether they are overassessed when assessments are kept at market value. For example, if a home is estimated to be worth $100,000 but the assessed value is $90,000, the property owner might think the property is underassessed. However, if the level of assessment is less than 100% of market value, the property might be overassessed. If, indeed, the home's market value is $100,000, but the municipality is assessing at 80% of market value, the assessed value should be $80,000. In this case, the $90,000 property is overassessed by $10,000. Community-wide reassessment. Keeping values up to date each year does not necessarily mean that the property owner's assessment will increase. Market values of properties may stay the same or go down, which means that some properties should see a decrease in assessed values. If the assessment does increase, it doesn't mean that the taxes will automatically increase. In some cases, a municipality will go from a fractional level of assessment to 100% if the original level of assessment was 10%, and the current level of assessment is 100%. The assessed value could go from $9,000 to $90,000, and the property owner might not see any increase in taxes. In addition, if the assessment increases, but the assessments of most other properties increase more, that owner's share of the taxes could decrease. For instance, if one owner's assessment increased by 3%, but most other property owners saw increases of 5%, the homeowner with the 3% increase will likely see a decrease in taxes. Reassessment upon sale. Usually, the assessment of a property does not change when the property is sold. For example, if Peter Jones buys a home in Alexandria, New York for $300,000 and the home is currently assessed at $200,000, the home must still be compared equitably to other similar homes. If the Alexandria assessor raises Peter's assessment to $300,000, which may be the fair market value of the home, technically speaking, the assessor must increase the assessment on the other homes that are similar. Due to the volume of home sales in any given time period, increases in assessments will probably not happen right away. Legal versus illegal reassessment. There are certainly legitimate reasons for an assessor to change the assessment on a property. But if a property owner believes that a change in the assessment is unfair or unlawful, he or she has the right to protest the change. We'll discuss the grounds for such protests, along with the procedure for filing a protest, later in this chapter. Back taxes. Unpaid property taxes, often referred to as back taxes, are usually paid at closing when the title transfers. In most cases, unpaid taxes do not affect a property's reassessment. However, if a new owner takes title to a property that has not yet been assessed when the owner takes possession, when the property is fully assessed, the municipality will not be entitled to any back taxes. Tax rate. The tax rate is determined by the amount of the tax levy, which we discussed on an earlier screen. There are several steps involved in determining the tax levy. 1. The taxing jurisdiction, which could be a school district, town, county, village, city or special district, develops and adopts a budget. 2. The revenue from all sources other than the property tax, such as state aid, sales tax revenue, user fees and federal aid, is estimated. 3. The total of the estimated revenues is subtracted from the original budget and the remainder becomes the tax levy. The tax levy is the amount of money the municipality must raise through the property tax. The tax rate is determined by dividing the total amount of money that has to be raised from the property tax by the taxable assessed value of taxable real property in a municipality. The municipality sets the tax rate to meet its budgetary requirements. The formula for calculating the tax rate is rate equals tax dollars needed divided by taxable assessed value. Tax rate calculations. The tax bill is typically stated as some number of tax dollars per $1,000 of assessed value, such as $25 for each $1,000 of assessed value. If, for example, a town levy is $2 million, and the town has a taxable assessed value of $40 million, the tax rate would be $50 for each $1,000 of taxable assessed value. $2 million $40 million equals 0.050 x $1,000 equals $50. Municipalities can choose to express the tax rates differently, such as dollars per hundred, dollars per thousand, mils, 1/10 of a cent, percentage. It would be helpful for you to find out what the standard is in your area. Property tax bill calculations. We did some examples of calculating property taxes on an earlier screen, but let's do a short review. Remember that the formula for calculating property taxes is assessed value x tax rate equals annual taxes. In our tax rate example on the previous screen, we calculated a tax rate of $50 for each $1,000 of assessed value. So, let's continue with an example using that tax rate. A home valued at $100,000 is assessed at a uniform percentage rate of 15%. The assessed value of that home would be $15,000. Using the tax rate of $50 per $1,000 of value, the tax bill for the home would be $750. The $750 results from dividing the assessment of $15,000 by $1,000 to get $15. Then, the $15 is multiplied by the tax rate to get the tax bill of $750. $15,000 $1,000 equals $15 x $50 equals $750. Let's do another example using the mill rate. A home is assessed at $90,000. If the tax rate is 30 mills, the tax will be $2,700. 30 mills is equal to 0.030. $90,000 x 0.030 equals $2,700. Calculating tax bills. Your turn. Calculate the tax bills for the following properties. Then go to the next screen to check your answers. 1. Greg's home is valued at $250,000. The home is assessed at 80% of its value. The tax rate is $2.25 per $100 of assessed value. What is Greg's annual tax bill? 2. Sally's home is valued at $150,000. The home is assessed at 100% of its value. The tax rate is $30 per $1,000 of assessed value. What is Sally's annual tax bill? 3. Jim's home is valued at $350,000. The home is assessed at 40% of its value. The tax rate is 25 mills. What is Jim's annual tax bill? 4. Susan's home is valued at $300,000. The home is assessed at 90% of its value. The tax rate is 5%. What is Susan's annual tax bill? Calculating tax bills. Here are the correct answers. 1. Greg's home is valued at $250,000. The home is assessed at 80% of its value. The tax rate is $2.25 per $100 of assessed value. What is Greg's annual tax bill? $250,000 X.80 equals $200,000. $200,000 divided by $100 equals $2,000. $2,000 x $2.25 equals $4,500. Point 2. Sally's home is valued at $150,000. The home is assessed at 100% of its value. The tax rate is $30 per $1,000 of assessed value. What is Sally's annual tax bill? $150,000 divided by $1,000 equals $150. $150 x $30 equals $4,500. 3. Jim's home is valued at $350,000. The home is assessed at 40% of its value. The tax rate is 25 mils. What is Jim's annual tax bill? $350,000 X.40 equals $140,000. $140,000 x $0.025 equals $3,500. 4. Susan's home is valued at $300,000. The home is assessed at 90% of its value. The tax rate is 5%. What is Susan's annual tax bill? $300,000 X.90 equals $270,000. $270,000 X.05 equals $13,500. Various taxing jurisdictions. Unlike most states, there is no personal property tax in New York. Instead of taxing items such as jewelry and vehicles, only real property is taxed. In New York State, the property tax is a local tax, raised by assessing units in the counties, cities, towns, and villages. While the state itself does not collect or receive any direct benefit from the property tax, this tax is still of major importance as the largest single revenue source for the support of municipal and school district services. As we noted earlier, the assessor is the elected or appointed official who estimates the value of real property in the locality. Most assessors must complete a training program to become certified by New York State within 3 years of taking office. All cities and towns in New York are assessing units with their own assessors, with the exception of Nassau and Tompkins counties which have county-wide assessing. Villages are also assessing units, although they can opt out and levy their taxes on the village portion of the town roll. As the basis for collecting their taxes, school districts and special districts rely on the assessment rolls that other assessing units prepare. Equalization. The New York State Office of Real Property Services is compelled by statute to administer an equalization program in order to assure fair property tax allocation among nearly 4,000 taxing jurisdictions in New York State, and to ensure the proper allocation of state aid to education funds, among other purposes. Equalization seeks to measure the relationship of locally assessed values to an ever-changing real estate market. Equalization is necessary in New York for several reasons. There is no fixed percentage at which property must be assessed. Municipalities can set their own percentages. Not all municipalities assess property at the same percentage of market value. One city may assess its property at 80% of value, while the city next door may assess at 10% of value. So, in two geographically close cities, properties with the same market values may have significantly different assessed values. Taxing jurisdictions, such as most school districts, do not share the same taxing boundaries as the cities and towns that are responsible for assessing properties. Most of the state's more than 700 school districts distribute their taxes among segments of several municipalities, many of which have different levels of assessment. This method of setting aside funds for a specific purpose is known as appropriation. The number of municipal segments in a school district can range from 1 to 15 or more. Equalization rates. OR has developed an equalization rate to determine at what % of market value different municipalities are assessing. At its simplest, an equalization rate is the state's measure of a municipality's level of assessment. This is the ratio of total assessed value to the municipality's total market value. The municipality determines the avenue the state estimates the M fee. The equalization rate formula is total assessed value divided by total market value equals equalization rate. Equalization rates do not indicate the degree of uniformity among assessments within a municipality. An equalization rate of 100 means that the municipality is assessing property at 100% of market value. An equalization rate of less than 100 means that the municipality's total market value is greater than its assessed value. An equalization rate of greater than 100 means that the total assessed value for the municipality is greater than its total market value. There would be no need for equalization if all municipalities assessed all property at 100% of market value every year. Equalization rates. The real property tax law requires that state equalization rates be established annually for each county, city, town and village. Equalization rates are calculated each year to reflect that year's assessment roll and current market values for each assessing unit. Aside from apportionment of taxes among municipal segments of school districts and counties, and distribution of state aid for education, there are other uses of equalization rates, including establishment of tax and debt limits, allocation of costs, such as for jointly operated hospitals among participating localities or an injury to a volunteer firefighter. Determination of state assessments or approval of local assessments. Determination of ceilings and exemptions. Determination of level of X.A.R exemptions. Apportionment of sales tax revenues and joint indebtedness. As evidence in court proceedings on the issue of assessment inequity and small claims assessment review hearings. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. Each year, state law requires assessors to sign an oath that states what? 2. What is a tax levy? 3. Why is equalization necessary in New York? 4. How often must equalization rates be established? Check your understanding. Answers 1. Each year, state law requires assessors to sign an oath that states what? The community assessments represent a uniform percentage of market value. 2. What is a tax levy? The tax levy is the amount of money the municipality must raise through the property tax. 3. Why is equalization necessary in New York? There is no fixed percentage at which property must be assessed. Not all municipalities assess property at the same percentage of market value. Taxing jurisdictions, such as most school districts, do not share the same taxing boundaries as the cities and towns that are responsible for assessing properties. 4. How often must equalization rates be established? The real property tax law requires that state equalization rates be established annually for each county, city, town and village. Special assessment districts. A special assessment is a tax levied against specific properties that will benefit from a public improvement. The assessment creates a specific lien against the property until it is paid. Common examples are assessments for sidewalks, water service and sewers. Special assessments are based on the cost of the improvement and apportioned on a pro rata basis among benefiting properties according to the value that each parcel will receive from the improvement. For example, a dredging project is approved to deepen the canals for a canal front subdivision. The project cost is $50,000. Although there are 100 properties in the subdivision, only the 50 that are directly on the canal stand to benefit. Therefore, assuming each canal front lot receives equal benefit, the 50 properties are each assessed $1,000 as a special assessment tax. Note that once the work is completed and paid, the assessment is discontinued. If a taxing entity initiates an assessment, the assessment creates an involuntary tax lien. If property owners initiate the assessment by requesting the local government to provide the improvement, the assessment creates a voluntary tax lien. Special assessments are usually paid in installments over a number of years. However, Taxpayers generally have the option of paying the tax in one lump sum or otherwise accelerating payment. Exemptions. Many different types of exemptions are available to qualifying property owners. The most common real property exemptions are for veterans, low-income senior citizens, farmers, clergy and non-profit educational, religious and charitable organizations. The state-funded school tax relief exemption program is available to all homeowners in New York State, as long as the property is their primary residence. Although local governments do not have the authority to create exemptions, the localities in most cases are authorized by state law to determine whether they will grant the exemptions and, if granted, what the amounts will be. The more exemptions that are permitted, the smaller the property tax base becomes in the community. The property tax burden then becomes greater for those property owners who have no exemptions. An exception to this is the S.T.A.R. program, which is a state-funded exemption that does not reduce local tax bases. The S.T.A.R. program. S.T.A.R. is New York State's school tax relief program that includes a school property tax rebate program and a partial property tax exemption from school taxes. All New Yorkers who own and live in their home, whether it's a 1 to 3 family home, condominium, cooperative apartment, manufactured home, farm dwelling, apartment building or mixed-use property, are eligible for the S.T.A.R. exemption on their primary residence. There are two parts to the S.T.A.R. property tax exemption. The basic S.T.A.R. exemption is available for owner-occupied, primary residences regardless of the owner's ages or incomes. Basic S.T.A.R. works by exempting the first $30,000 of the full value of a home from school taxes. The enhanced S.T.A.R. exemption is available for the primary residences of senior citizens with yearly household incomes not exceeding the statewide standard. For qualifying senior citizens, the enhanced S.T.A.R. program works by exempting the first $60,100 of the full value of their home from school property taxes. For property owned by a husband and wife, or by siblings, only one of them must be at least 65 years of age as of December 31st of the year in which the exemption will begin to qualify for the enhanced exemption. Their combined annual income, however, must not exceed the S.T.A.R. income standard. Veterans exemptions. The eligible fund's Veterans Real Property Tax Exemption provides a partial exemption where property owned by a veteran or certain other persons designated in the law has been purchased with pension, bonus, or insurance monies, referred to as eligible funds. Another exemption, known as the Alternative Veterans Exemption, is available only for residential property of veterans who served during wartime or received a medal. Each county, city, town and village was given the option of deciding not to grant this alternative exemption. A municipality, however, which initially opted not to grant the alternative exemption, may decide to change its decision and grant the exemption. Veterans need to check with the assessor or the clerk of the municipality in which their residence is located to determine if the alternative exemption is in effect. The alternative exemption provides a property tax exemption of 15% of assessed value to veterans who served during wartime and an additional 10% to those who served in a combat zone. The law also provides an additional exemption to disabled veterans equal to 1/2 of their service-connected disability ratings. Veterans exemptions. The alternative exemption is applicable only to general municipal taxes and not to school taxes or special district levies. Unlike the eligible fund's veterans exemption, however, the alternative exemption is limited to the primary residence, including, at local option, a cooperative apartment of a veteran and is not based on eligible funds. A third exemption, known as the Cold War Veterans Exemption, is available only for residential property of veterans who served during the Cold War period. Counties, cities, towns and villages have the option of granting a reduction in the amount of property taxes paid by veterans who qualify for this exemption. The basic exemption is limited to 10 years, but there is no time limit for the disabled portion of this exemption. In both instances, the exemption is limited to the primary residence of the veteran and is applicable only to general municipal taxes, not to school taxes or special district levies. This exemption is not available to those veterans currently receiving either the eligible funds or alternative veterans exemption. These veterans exemptions are not automatic. Any veteran seeking an exemption must file an application with the local assessing unit. Senior Citizens Exemption. New York State real property tax law gives local governments and public school districts the option of granting a reduction on the amount of property taxes paid by qualifying senior citizens. This is accomplished by reducing the taxable value of residential property owned by seniors by 50%. To qualify, seniors generally must be 65 years of age or older and meet certain income limitations and other requirements. For the 50% exemption, the law allows each county, city, town, village, or school district to set the maximum income limit at any figure between $3,000 and $27,000. The local option maximum income must not exceed $29,000, beginning July 1, 2009. In addition, seniors must show they have owned the property for at least 12 consecutive months prior to the date they filed their application, unless they had a senior citizen exemption for their previous residence, in which case the 12-month requirement is considered satisfied. Localities also have the option of giving exemptions of less than 50% to seniors whose incomes are more than $27,000. Under this option, called the sliding scale option, an owner can have a yearly income as high as $35,399.99 and get a 5% exemption in places that are using the maximum limit. Seniors are advised to check with their local assessor, city town clerk, or school district to determine which local options, if any, are in effect. Disability exemption. New York state law also gives local governments and public school districts the option of granting a reduction in the amount of property taxes paid by qualifying persons with disabilities. To qualify, persons with disabilities generally must have certain documented evidence of their disability and meet certain income limitations and other requirements. They also must file the exemption application with their local assessor by the appropriate filing date. Similar to the senior exemption, the basic exemption is a 50% reduction in the assessed value of the legal residence of the qualifying disabled person. For the basic exemption, the law allows each county, city, town, village, or school district to set the maximum income limit at any figure between $3,000 and $27,000. The local option maximum income must not exceed $29,000. Beginning July 1, 2009. Localities have the further option of giving exemptions of less than 50% to persons with qualifying disabilities whose incomes are more than $27,000. Under this option, called the sliding scale option, a qualifying owner can have a yearly income as high as $35,399.99 and get a 5% exemption in places that are using the maximum limit. Note, however, that if the property is receiving an exemption under the Low-Income Senior Citizens Exemption, it cannot also receive an exemption under this law for the same municipal tax purpose. A property eligible for the Persons with Disabilities Exemption, however, can receive other exemptions, such as those for school tax relief, veterans, etc. when the property is owned by one or more persons, some of whom qualify for this exemption and the others of whom qualify for the Senior Citizens Exemption. The owners have the option of choosing the more beneficial exemption. The owners may not be prohibited from taking one of these two exemptions solely because the owners qualify for more than one exemption. Other exemptions: agriculture farm buildings. For newly constructed or reconstructed agricultural structures, New York's real property tax law allows a 10-year property tax exemption. Application for the exemption must be made within 1 year after the completion of such construction. The agricultural structures and buildings will be exempt from any increase in the property's assessed value resulting from the improvement. Once granted, the exemption continues automatically for 10 years. The exemption will terminate before the 10-year period if either the building or structure ceases to be used for farming operations. The building or structure or land is converted to a non-agricultural or non-horticultural use. Special use structures. A one-time application provides a permanent exemption from taxes, special ad valorem levies, and special assessments for certain limited-use agricultural structures. The law specifically lists silos, bulk milk tanks, manure storage and handling facilities, farm feed grain storage bins and commodity sheds as qualifying for this exemption. Other exemptions: agriculture historic barns. This exemption is only available after local approval of the exemption. A historic barn is defined as a structure at least partially constructed before 1936 that was originally designed and used for storing farm equipment or agricultural products or for housing livestock. The exemption applies to a reconstruction or rehabilitation that was started after the effective date of the local law or resolution. The exemption authorized by the local law is for a 10-year period. In the first year, the barn is eligible for an exemption from taxation equal to 100% of the barn's increase in assessed value that was attributable to the reconstruction or rehabilitation. In the ensuing 9 years, the extent of the exemption is decreased annually by 10%. Temporary greenhouses. A one-time application provides a permanent exemption from taxes, special ad valorem levies, and special assessments for temporary greenhouses. Once an exemption is granted, no renewal is necessary. The law defines a temporary greenhouse as specialized agricultural equipment having a framework covered with demountable polyethylene or polypropylene materials or materials of a polyethylene or polypropylene nature which is specifically designed, constructed and used for agricultural production. A temporary greenhouse may include, but is not limited to, the use of heating devices, water and electrical utilities, and embedded supporting poles. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. What is the special assessment? 2. What is the S.A.R program? 3. Whose property is eligible for the alternative veterans exemption? 4. What does the senior citizens exemption do? Check your understanding. Answers 1. What is the special assessment? A special assessment is a tax levied against specific properties that will benefit from a public improvement. 2. What is the S.A.R program? S.A.R is New York State's school tax relief program that includes a school property tax rebate program and a partial property tax exemption from school taxes. 3. Whose property is eligible for the alternative veterans exemption? The alternative veterans exemption is available only for residential property of veterans who served during wartime or received a medal. 4. What does the senior citizens exemption do? It reduces the taxable value of residential property owned by qualifying seniors by 50%. Protesting assessments. As we have discussed earlier, assessments are determined by the assessor, an elected or appointed local official, who independently estimates the market value of real property in your community. The assessor is obligated by New York state law to maintain assessments at a uniform percentage of market value each year. Assessors are interested only in fairly assessing property in their assessing unit. However, factual errors can and do occur sometimes in deriving the assessment. The assessment roll shows the assessments and appropriate exemptions. Every year the roll, with preliminary or tentative assessments, is made available for public inspection. The assessor is continually communicating with the public, answering questions, and dealing with concerns raised by taxpayers. Anyone can examine the assessment roll and property records at any time. It is up to individual property owners to monitor their own assessments. Taxpayers who feel they are not being fairly assessed should meet with their assessor before the tentative assessment roll is established. In an informal setting, the assessor can explain how the assessment was determined and the rationale behind it. Informal meetings with assessors to resolve assessment questions about the next assessment roll can take place throughout the year. If, after speaking with the assessor, the taxpayer still feels that he or she has been unfairly assessed, the taxpayer can prepare and file a complaint with the local Board of Assessment Review. Note: all complaints in relation to assessments on city, town and village assessment rolls must be made. Filing complaints. Who can file? Any person injured by an assessment may file a complaint using Form RP 524. The taxpayer may complete the complaint form or have his or her representative or attorney complete it. The form is also available from the assessor's office or the county real property tax services office. What assessment may be reviewed? The only assessment that may be reviewed is the assessment on the current tentative assessment roll completed by the local assessor. As a general rule, a separate complaint should be filed for each separately assessed parcel. Where must the complaint be filed? The complaint must be filed in the city or town in which the property is located, with either the assessor or the Board of Assessment Review. The taxpayer may deliver the complaint in person or mail it. If the property is located in a village which assesses property, there will be two assessments, one by the village and one by the town. When must the complaint be filed? The taxpayer may file the complaint with the assessor on or before the first day the bar meets to hear complaints, or with the bar on the day it meets. If the complaint is filed fewer than 4 business days before the bar meets, the board is required to grant the assessor's request for an adjournment to allow the assessor to prepare a response to the complaint. Formal reviews. All property owners in New York State are eligible for a formal review of their property's assessments. There are 2 levels of formal review. Administrative review via the grievance process conducted in each assessing unit. Judicial review via Supreme Court trial or small claims assessment review. In order to pursue judicial review, a taxpayer must first go through administrative review. Grievance Board. The Board of Assessment Review hears grievances. The bar consists of 3 to 5 members appointed by the legislative body of the assessing unit. The bar cannot include the assessor or any staff from the assessor's office. Assessors, however, are required to attend all formal hearings of the board and have the right to be heard on any complaint. Taxpayers may appear before the board in person, send a representative such as an attorney, or choose not to appear. However, the bar may require the taxpayer or his/her representative to appear personally or to submit additional evidence. If the taxpayer or taxpayer's representative willfully refuse to do so, or refuse to answer any material question, the taxpayer will not be entitled to a reduction in assessment. The taxpayer must keep in mind that the law will assume that the assessor is correct. So, the burden of proof of the taxpayer's wrongful assessment lies with the taxpayer. The grounds for assessment review in New York are: unequal assessment, excessive assessment, unlawful assessment, misclassification. Unequal assessment. Generally, if assessments in a taxpayer's city, town or village are not made at full value, state law requires that they be made at a uniform percentage of value, as we have previously discussed. If a taxpayer believes that his or her property is assessed at a higher percentage of value than the average of all other properties on the same assessment roll, the taxpayer may claim an unequal assessment. For example, if the taxpayer can prove the value of his or her property is $60,000, an assessment of $45,000 would show that the property is assessed at 75% of market value. If the taxpayer proves that all other property on the average is assessed at 50%, the taxpayer may claim a reduction of the assessment to $30,000. To demonstrate that the property is unequally assessed, the taxpayer must first establish the full value of the property. The following information may be useful in establishing property value. Purchase price of the property, if recently purchased. Offering price of the property, if recently offered for sale. Professional appraisal of the property. Cost of construction, if recently built. Rental information, if property is rented. Income and expense information, if property is commercial or industrial. Purchase price of comparable property recently sold. Assessment ratio. Unequal assessment. Then the taxpayer must establish the average percentage of value at which all other properties are assessed on the same assessment roll. The following information may be useful in establishing the average percentage of value for the other properties on the assessment roll. The uniform percentage of value appearing on the assessment roll. The latest state equalization rate or residential assessment ratio for the assessing unit, which is available from the assessor, County Director of Real Property Tax Services, or the State Board of Real Property Services. Market values and assessments of a sample of other properties on the same assessment roll. Purchase price and assessment of other properties recently sold. Statements of the assessor or other local official excessive assessment. Complaints in this category fall into three groups. Overvaluation. If a taxpayer believes the assessed valuation of the property is greater than the full market value of the property, the taxpayer may claim an excessive assessment. To establish the full market value of the property, the taxpayer should supply the kind of information talked about on the previous screen. Incorrect partial exemption. If the taxpayer's property was denied all or a portion of a partial exemption, the taxpayer may also claim an excessive assessment. If the taxpayer filed an application for the partial exemption with the assessor, he or she should submit a copy of the application with the complaint or ask the assessor to submit it to the bar. Excessive transition assessment. Cities, towns and villages certified by the State Board as approved assessing units may adopt a system of transition assessments to phase in, over a period of 5 years, all increases and decreases in assessed valuations resulting from a revaluation. If a taxpayer's city, town or village has adopted transition assessments and the taxpayer believes that the transition assessment for his or her property has been improperly calculated, the taxpayer may claim an excessive assessment. Unlawful assessment. This category pertains to properties that are wholly exempt under the law, such as churches, colleges or other similar organizations and agencies. Assessment of these properties would constitute an unlawful assessment. Other grounds for claiming an unlawful assessment include the following. The property in question is entirely outside the boundaries of the city, town, village, school district or special district in which it is designated as being located. The property was assessed by someone other than the assessor. The assessment was entered or changed after the tentative assessment roll was filed. The property cannot be identified from the description on the assessment roll. The property is special franchise property and the assessment exceeds the final assessment as determined by the State Office of Real Property Services. Misclassification. These grounds are relevant only in approved assessing units which have established homestead and non-homestead tax rates, as we talked about earlier. There are two possible claims of misclassification. 1. The parcel has been designated in the wrong class on the assessment roll. 2. The allocation of the parcel's total assessed value between the homestead and non-homestead parts is incorrect. For example, a 100-acre parcel is assessed for $250,000. The assessor allocates $75,000 of that amount to the residence and surrounding 10 acres, and allocates the other $175,000 to the remaining 90 acres. The taxpayer believes that the $250,000 total assessment is correct, but contends that the residence and 10 acres are worth one-half of the total, or $125,000. The question of allocation will be significant because of the different tax rates for the homestead and non-homestead classes. In this case, the taxpayer may claim that the property is misclassified and request that the assessed value be allocated equally between the residence and surrounding 10 acres and the remaining 90 acres. Note: if a taxpayer is contesting only the allocation without seeking review of the total assessed value, he or she needs to raise only the misclassification claim. However, if the taxpayer believes that the assessment is unequal or excessive and the allocation between the homestead and non-homestead parts is incorrect, then he or she should indicate both misclassification and unequal or excessive assessment on the claim form. Possible outcomes. After the Assessment Review Board has completed its hearing, they will make one of three decisions: full denial of the claim, full reassessment of the property, partial reassessment of the property. The bar must mail to each complainant a notice of the board's determination, except where the board ratifies a stipulated assessment. The notice must contain a statement of the reasons for the board's determination. If the taxpayer is dissatisfied with the decision of the bar, he or she may seek judicial review by commencing a tax certiorari proceeding in New York State Supreme Court or by commencing a proceeding for small claims assessment review. Either of these procedures must be commenced within 30 days of the filing of the final assessment roll or notice of such filing, whichever is later. Since the Supreme Court review is too expensive for most homeowners, most will choose a small claims review process, which we will discuss on the next screen. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. What should a taxpayer do who feels that he or she is not being fairly assessed? 2. What are the two levels of formal review available? 3. What are the 4 grounds for assessment review? 4. What are the possible outcomes of an administrative review? Check your understanding. Answers 1. What should a taxpayer do who feels that he or she is not being fairly assessed? Taxpayers who feel they are not being fairly assessed should meet with their assessor before the tentative assessment roll is established, so the assessor can explain how the assessment was determined and the rationale behind it. 2. What are the 2 levels of formal review available? Administrative review via the grievance process conducted in each assessing unit, judicial review via Supreme Court trial, or small claims assessment review. 3. What are the 4 grounds for assessment review? Unequal assessment, excessive assessment, unlawful assessment, misclassification. 4. What are the possible outcomes of an administrative review? Full denial of the claim, full reassessment of the property, partial reassessment of the property, small claims assessment review. The small claims assessment review is only available to owner-occupants of 1, 2 or 3 family dwellings which are used exclusively for residential purposes, or the owners of vacant land that is not of sufficient size to contain a 1, 2 or 3 family dwelling. Persons not eligible to file include cooperative owners, apartment renters, condominiums owners, except those owner-occupied condominiums used exclusively for residential purposes that are located in Nassau County and designated as Class 1 property, and condominiums that have been designated in the homestead class in any approved assessing unit. Non-residential building owners, large vacant lot owners, farm building owners, commercial property owners. The complainants may not request an assessment reduction that is greater than the one they previously sought during the Board of Assessment review. Filing. The petition must be filed with the clerk of the county in which the real property is located, within 30 days of the filing of the final assessment roll for that assessing unit. The petition must be accompanied by a $30 filing fee with supporting statements, records, and other relevant information to support the petition. Hearing procedure. After the taxpayer has filed a petition, the assessment review clerk in the Supreme Court in the county will assign the case to a hearing officer. The hearing officer will contact the taxpayer directly to set a date, time and place for a hearing. Here are some points about the hearing procedure, many of which are the same as for a grievance hearing. The taxpayer may appear personally, with or without an attorney or other representative, to support the statements contained in the petition and attachments. The taxpayer may authorize an attorney or other representative to appear personally on his or her behalf to support the petition. This authorization must be in writing and bear a date within the same calendar year during which the petition is filed. There is a presumption under the law that the assessment made by the assessor is correct. The burden of proof is with the petitioner to overcome this presumption. The hearing officer will require the taxpayer or the taxpayer's representative to appear personally and may request that additional evidence be submitted. Failure to appear shall result in the petition being determined by the hearing officer based upon the available evidence submitted. The hearing officer may determine the final assessment to be the same as or less than the original assessment. However, he cannot reduce the assessment to an amount lower than the amount claimed on the petition. The amount of reduction on the petition is limited by the amount claimed. The amount by which the taxpayer believes the assessment should be reduced cannot later be changed after this amount is entered on the petition and filed. Further, the hearing officer cannot legally grant a greater reduction than the amount requested, even if circumstances show that a larger reduction is warranted. Hearing procedure. Types of evidence. The issues involved in a tax assessment dispute involve the fair market value of the property and the ratio of assessed to full market value. As mentioned in our earlier discussion on grievances, the taxpayer must establish the full value of the property and provide proof of those findings. Appraisal testimony is helpful here. The taxpayer should also bring information about the current residential assessment ratio as support for his or her claim. Note: the RARE can be used only in small claims assessment reviews for 1, 2, and 3 family owner-occupied residences. It cannot be used for a tax certiorari proceeding. Possible decisions. As with grievances, the small claims review will yield one of these decisions: full denial of the claim, full reassessment of the property, partial reassessment of the property. Appeal. If a taxpayer is not satisfied with the small claims review decision, his or her only option is to commence an Article 78 proceeding, as we discussed in a previous chapter. Persons who file for a small claims assessment review waive their rights to a tax certiorari proceeding in the state Supreme Court. Protesting commercial property assessments. Just like a X.A.R. review, a tax certiorari proceeding is a legal process that a property owner can use to challenge his or her property tax assessment. A judicial review of an assessment is a proceeding brought under Article 7 of the Real Property Tax Law. According to Article 7, if a taxpayer has not filed a grievance complaint, he or she cannot have a judicial review. Here are the important points to know about a tax certiorari proceeding. The proceeding is commenced by the filing of a notice of petition and petition in the county clerk's office in a county located in the judicial district where the property is located. For purpose of statute of limitations, the notice of petition and petition must be filed within 30 days of the last date allowed by law for the filing of the final assessment roll for the municipality. The case is heard in the New York Supreme Court. A taxpayer is ordinarily represented by an attorney because of the legal complexity of this Supreme Court proceeding. Alternatively, the petitioner may represent himself or herself but may not designate a non-attorney to represent him or her in an Article 7 proceeding, as is possible in an administrative review. The overwhelming majority of Article 7 tax assessment review proceedings involve commercial property. Homeowners have access to the small claims assessment review we talked about earlier, which may be a preferable way of proceeding since the tax is likely to be recovered on a residential property ordinarily do not justify the cost of an Article 7 proceeding. Tax liens. A tax lien is a lien against real property for the failure to pay property taxes. A tax lien, like other lien types, generates an encumbrance against the property, which is removed when the taxes are paid. Tax liens take priority over other liens, meaning that when title to a property is transferred, the tax lien should be paid first. If taxes remain unpaid for a period of time specified by state law, the tax collecting agency may enforce the tax lien in several ways. The local official can bring a legal action, called an in rem legal proceeding, to collect the taxes. An in rem proceeding is one that is directed against a thing, rather than against a person. Typically, this involves a forced sale of the property. Some states sell tax certificates. The buyer of a tax certificate agrees to pay the taxes due. After a period of time specified by law, the holder of the tax certificate on a property may then apply for a tax deed. A tax deed is a legal instrument for conveying title when a property is sold for non-payment of taxes. The application for a tax deed causes the taxing agency to institute a tax sale or tax foreclosure. Administrative tax sale. New York allows its taxing districts to foreclose on a property and hold an administrative tax sale to recover the taxes owed on the property. This is a variation of the tax certificate remedy we talked about on the previous screen. Local laws dictate a specified time period for delinquent taxes, after which time a list of such properties is published. The property owner receives a notice of the tax sale, and when the property is actually sold, the buyer becomes responsible for paying the interest and penalties that have accrued on the property. The buyer receives a certificate of sale assigning the tax lien. The owner then has the option of paying the taxes to the buyer during some specified time period. If the owner does not pay the taxes, the buyer receives a deed from the city treasurer and can choose to record the deed or foreclose on the lien. Tax foreclosure and sale. If a tax district holds a tax lien for longer than 4 years, the tax lien could be sold to the taxing district, as long as the property owner is notified and the status as a delinquent property is published. A tax deed is executed, delivered to the taxing district and properly recorded. 2 years after the deed is recorded, the taxing district can sell and deed the property to a buyer. This is a popular procedure in New York because it is easy and inexpensive. Agents' responsibilities. So, what does all this mean to you? When buyers are looking for property, the amount they can expect to pay in property taxes yearly is an important consideration. Real estate agents should be prepared to research the amount of taxes on a property and give that information to their buyer clients. Read and interpret tax bills. Explain the information on a tax bill to clients. Research any tax exemptions or reductions that may apply to a particular client. You may also find other information about the property taxes for a particular property included in the title search. Remember, the more knowledgeable you are, the better resource you are to your client. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. Who is eligible to avail themselves of the Small Claims Assessment Review? 2. If a taxpayer is not satisfied with the decision of the X.A.R hearing officer, what options does he or she have? 3. Who may and who may not represent a taxpayer in a tax certiorari proceeding? 4. What is an in rem legal proceeding? Check your understanding. Answers 1. Who is eligible to avail themselves of the Small Claims Assessment Review? The Small Claims Assessment Review is only available to owner-occupants of 1, 2 or 3 family dwellings which are used exclusively for residential purposes, or the owners of vacant land that is not of sufficient size to contain a 1, 2 or 3 family dwelling. 2. If a taxpayer is not satisfied with the decision of the X.A.R hearing officer, what options does he or she have? His or her only option is to commence an Article 78 proceeding. Persons who file for a Small Claims Assessment Review waive their rights to a tax certiorari proceeding in the state Supreme Court. 3. Who may and who may not represent a taxpayer in a tax certiorari proceeding? A taxpayer can be represented by an attorney or may represent himself or herself, but may not designate a non-attorney to represent him or her in an Article 7 proceeding, as is possible in an administrative review. 4. What is an in rem legal proceeding? An in rem proceeding is one that is directed against a thing, rather than against a person, as in a legal proceeding for the recovery of property. Summary review. This concludes Chapter 26. Below is a summary which you can review before taking your quiz. The purpose of taxation is to raise funds to pay for municipal services. The collection of taxes provides important revenue for the local government and for area schools. Property taxes are levied on an ad valorem basis, meaning that they are based on the assessed value of the property. Assessed value is determined according to state law, usually by a county or township assessor or appraiser. In New York, The real property tax is based on a property's fair market value. All real property in New York is subject to assessment. All real property in New York is also subject to taxation, unless specific legal provisions granted exempt status. Tax bills are calculated based on two items of information: the assessment of the property, the tax rates of the tax district in which the property is located. The property's assessment is a percentage of its fair market value, which is the amount the property would sell for in the current market. An assessing unit is a city, town, county or village that has the power to assess real property. An approved assessing unit is tax district that has been certified by the NYS Office of Real Property Services as having completed a property revaluation program, which implements a system of real property tax administration that would be eligible for state assistance. Summary review. New York state law provides that all property in a municipality be assessed at the same uniform percentage of value. The tax levy is the amount of money the municipality must raise through the property tax. The New York State Office of Real Property Services is compelled by statute to administer an equalization program in order to assure fair property tax allocation among its taxing jurisdictions and to ensure the proper allocation of state aid to education funds. The real property tax law requires that state equalization rates be established annually for each county, city, town and village. A special assessment is a tax levied against specific properties that will benefit from a public improvement. The assessment creates a specific lien against the property until it is paid. Many different types of exemptions are available to qualifying property owners. The most common real property exemptions are for veterans, low-income senior citizens, farmers, clergy and non-profit educational, religious and charitable organizations. Summary review. Taxpayers who feel they are not being fairly assessed should meet with their assessor before the tentative assessment roll is established, so that the assessor can explain how the assessment was determined and the rationale behind it. If, after speaking with the assessor, the taxpayer still feels that he or she has been unfairly assessed, the taxpayer can prepare and file a complaint with the local Board of Assessment Review. There are two levels of formal review. Administrative review via the grievance process conducted in each assessing unit. Judicial review via Supreme Court trial or small claims assessment review. In order to pursue judicial review, a taxpayer must first go through administrative review. The grounds for assessment review in New York are unequal assessment, excessive assessment, unlawful assessment, misclassification. If a property owner is delinquent in paying his or her taxes, the taxing jurisdiction can impose a tax lien against the property. Click here if you would like to open this summary as a PDF, which you can then print or save to your device. Chapter 26 Summary. Chapter Conclusion. In this chapter, we have discussed the purpose of taxation, how to calculate real estate taxes, how property is assessed, special assessments, types of property tax exemptions, the process for protesting an assessment. In the next chapter we'll discuss various issues surrounding condominiums and cooperatives. Next up, your chapter quiz. Good luck! 1 of 19. The real property tax law requires that state equalization rates be established for annually each county, city, town and village. 2 of 19. Excessive assessment complaints fall into any one of the following categories except denial of permanent exemption. 3 of 19. Who is eligible to a small claims assessment review? Single-family homeowner occupant. 4 of 19. A homeowner's total tax bill is derived by multiplying each district's tax rate times the assessed value of the owner's property. 5 of 19. Local taxing authorities can make real property exemptions. A common exemption is made for military veterans. 6 of 19. Which limited-use farm structure does not qualify for a permanent property tax exemption? Milking barn. 7 of 19. To recover taxes owed on a property, the state of New York allows a taxing district to foreclose on the property and hold an administrative tax sale. 8 of 19. A proceeding is a legal process that a property owner can use to challenge his or her property tax assessment. Tax certiorari. 9 of 19. What is a tax levy? The amount of money the municipality must raise through the property tax. 10 of 19. The New York State Office of Real Property Services developed an equalization rate to determine at what % of market value different municipalities are assessing. 11 of 19. The real property tax law requires state equalization rates to be established every year. 12 of 19. Which of the following would be considered a major tax district in most areas? School. 13 of 19. Each year, New York state law requires assessors to sign an oath that the community assessments represent a uniform percentage of market value. 14 of 19. Although Joe's home is valued at $300,000, it was assessed at 75% of its value. If the tax rate is $2 per $100 of assessed value, what is the amount of Joe's tax bill? $4,500. 15 of 19. What is the role of local tax districts? To impose property taxes for specific municipal services. 16 of 19. A veteran's property tax exemption is for property purchased with eligible funds. Which of the following does not fall in the eligible funds category? Lottery winnings. 17 of 19. Disabled persons may file for a basic property tax exemption of a 50% reduction of the assessed value. 18 of 19. Overvaluation is excessive assessment due to the valuation of the property being greater than the full market value of the property. 19 of 19. How is the equalization rate determined? Total assessed value divided by total market value.